A mortgage is a loan people use to buy a house, and there are two main types: fixed rate and adjustable rate mortgages. The difference is all in how the interest rate changes over time, and that can affect your monthly payments in a big way. Let's break it down in simple terms so you can see which one might be best for you. A fixed rate mortgage is exactly what it sounds like. The interest rate stays the same for the entire life of the loan. Whether it's a 15-year or 30-year mortgage, your monthly payment won't change. This is great for people who want predictability. Imagine you get a mortgage today with a 5% interest rate. Even if interest rates go up to 7% or even 10% years later, you'll still pay 5% for the life of your loan. That makes budgeting easier because you always know what you owe. The downside: fixed-rate mortgages often start with a higher interest rate than adjustable-rate mortgages, meaning your initial monthly payment could be higher. But if you're planning to stay in your home for a long time, this stability can be a huge advantage. Now, let's talk about adjustable-rate mortgages, or ARMs. Unlike a fixed-rate mortgage, the interest rate on an ARM can change. Typically, you start with a lower interest rate for a set period, often 5, 7, or even 10 years. This is called the fixed period. After that, the rate adjusts at regular intervals, usually once a year. If interest rates go down, your monthly payment could decrease. But if rates go up, so does your payment. Here's an example. Let's say you take out a 5-to-1 ARM with an initial rate of 4%. That means for the first 5 years, you're locked in at 4%, which is lower than a fixed-rate mortgage. But after that, your rate can change every year. If rates rise to 6% or 7%, your monthly payments could become much higher than you expected. ARMs can be a good choice if you don't plan to stay in the home long-term, or if you expect interest rates to drop in the future. But they also come with some uncertainty, which makes them riskier than a fixed-rate mortgage. So which one should you choose? If you want stability and plan to stay in your home for many years, a fixed-rate mortgage is usually the safer bet. But if you're looking for lower initial payments and don't mind the risk of rates increasing, an ARM could be a good option. Before making a decision, think about your long-term plans. Are you planning to stay in the house for 20 or 30 years? Then a fixed-rate mortgage might be the way to go. But if you're planning to move within a few years, an ARM could save you money in the short term. Also, consider your ability to handle potential increases in your monthly payments. If a rate hike would stretch your budget too thin, the stability of a fixed-rate mortgage might be better for you. It's also important to compare current interest rates and understand how the loan terms work. Some ARMs come with caps that limit how much the rate can increase at once or over the life of the loan. Make sure you read the fine print before choosing an ARM.